Oil and gas operations are complex. Finding your data shouldn't be. WellDrive puts data at your fingertips so you can stop searching and start doing. Learn more at info.welldrive.com.
Welcome to the 8th Annual DUG Midcontinent Conference. It's wonderful for you to join us today. We're really glad you're here. This session is very graciously sponsored by WellDrive. Thank you, WellDrive. This morning, we're going to hear from Tom Ward. Many of you in industry know Tom. Tom has had a more than 40-year career in oil and gas, primarily all of that in Oklahoma. Tom is currently chairman and CEO of Mach Resources. He was a co-founder of Chesapeake Energy. He was the founder of Sandridge Energy as well as Tapstone Energy. Tom's going to talk to us today about operations of Mach Resources, particularly in partnership with Bayou City Energy. Good morning, Tom.
Good morning, Nissa. Thank you for having me. Thank you, Hard Energy and the DUG Conference for being able to speak today. I think I can bring a little bit of hope to some people that in these very challenging times that we have, and that's my goal. And I just want to start back with a story of it has been 40 years since I graduated from college. I graduated in December of 1980, or left in December of 1980, and graduated in May of 1981. And at that time, there was a tremendous drilling boom going on in Oklahoma and across the country. We had deep gas was bringing $10 per MCF. There were high oil prices, and there were nearly 800 rigs, if not more, running just in Oklahoma. So it was a time that whenever I left college, I could have got a job anywhere. And I left the University of Oklahoma, and my wife and I, which today's our anniversary, 42 years, we've been married, and at that time we wanted to go back more to our roots in western Oklahoma, and I was able to find a job in Clinton, Oklahoma, which was a town of just about 10,000 people or so. So it just has been a long journey for me, but a seminal moment happened while I lived and you know, the Lord's providence to me was really that in 1980 and 81, there was not a house to be had in Clinton, Oklahoma, and is deep in the Anadarko Basin. And I was able to find a house about 5 miles outside of Clinton in the county seat of Custer County, Oklahoma, Arapahoe. And that's a town of about 500 people. And my wife and I settled in Arapahoe and met some wonderful people. And then later, in 1982, by the time we'd lived there a couple of years, the seminal moment was that on July 4th, 1982, Penn Square Bank failed. And at that time, everything changed. So the only time I've been without a job in my life was during that period just before Penn Square failed and right after. And so I ended up having to go and combine wheat for some local farmers. But the other thing that was very providential to me was that I lived in a time of very high taxes. So Ronald Reagan's president, we had a 70% tax bracket, and inflation was running at about 20%. And there were some wealthy men in the deep Anadarko Basin that had large interest in land that I was able to convince to partner with me and be able to put together a little bit of money. And at that time, in late 1982, I started my company just because I couldn't find another place to work, and I really didn't care to cut wheat the rest of my life. So I moved in to working with a couple of families, the Agans and the Waltrips, and they supported me with being able to start investing in wells. The point to this is that at a time when there's no capital, if you can put together a little bit of capital, if you can have an idea, and if you can move forward with that idea when no one else is doing what you're doing, you can start a company, you can make a way, you can make a living. That's all I was trying to do, was just to make a living. And within then a few months, within 6 months' time, I met a man named Aubrey McClendon who was doing exactly the same thing I was at exactly the same time with nearly the same amount of money with investors from Florida. And we both were the only two at our age group that we're competing with. We were competing, and we were competing with each other. Well, it didn't take us very long before we started to say, you know, we need to just join up, and we will have a way that we won't have any competition. Things today aren't that much different. We are without capital. This is an industry that is needing new capital to come in. We have, at two ends of a spectrum, we have the banks that are first lien lenders that aren't wanting to lend anymore. And you have the equity holders that are losing their companies. There has to be consolidation. There has to be a large consolidation of companies that will come together, and they'll move towards capital. The traditional second lien holders are moving to first lien and getting the same type of returns that they did with high yield in the past. And the new equity that is coming in is taking the place of the old equity. So those are the only two that are really being able to prosper at this time. But if somebody else comes in with any type of capital in this, in a very desperate time, probably the most desperate since 1982 that I've seen, that is a time that you can do well. And it wasn't that much different whenever I was at Chesapeake in 1998. There was an Asian crisis that made the world move down to basically what we did this year was a $10 oil price and very low gas prices, and it wiped out a lot of capital. But Chesapeake at that time had raised some capital, and we were able to go buy some properties and put that money to work. And we had an idea that future prices couldn't stay as low as they were, just because that no one had any money to go drill. We were at that time moved down to 400 gas rigs. Calpine is making a large decision that they wanted to move forward and build a new electrical generation using natural gas. And we just believed that buying gas assets was a good move for the company. And that proved to be correct. And so today, I've been able to partner with a very good partner who has seen and has the same ideas that I have had. For the last 5 years, I believe that our industry was moving too fast with too much capital, drilling wells too close together, using too large of fracs, having too many layers, and that depletion was an issue, and that we really couldn't make money at $50 oil. And I was on CNBC in 2015 and said that. And so as we moved forward, and I moved from Tapstone to Mach, our goal in 2017 was to buy distressed assets. And that's what we've done with Bayou City. There's on page the slide 1, I just lay out what Mach has done, how we're going forward, and who our partner is which is Bayou City Energy. We've made 7 acquisitions, and through those acquisitions, we built a decent-sized company. And as you can see on our asset overview, those are across Oklahoma. We focused on the Midcon. And the reason we did that is because in 2017, whenever we were looking at assets, the only distressed asset in the world was the Miss Lime. And so and there was a reason for that, because it produced a lot of water. But what we were fortunate to do, and have been fortunate in the deals we bought, is we get good midstream systems with this. And in that case, we had a midstream system that had been built for over $500 million that we were able to buy in the purchase price of the assets. We focused on proved developed producing assets, and we focused on free cash flow. So what we look for today, and have since we founded the company, and where Bayou City and us have made fantastic partners, is we both believe that you have to have cash on cash returns after debt service and after CapEx. So that's what we've done as a company. That's what we plan to keep on doing. And now I think it's going to be demanded by investors that that's what you have. That anybody who wants to come into this business has to be able to generate free cash flow after CapEx and after debt service. And there's really no way around that. Because the capital providers that I've already mentioned are gone, and the new providers only want to have free cash flow. As an industry, the last 15 years we've had growth through the drill bit, and that has proven over time to be it's taken away capital. So it's been a destroyer of capital. That's what I wanted to say. That we have not done a good job as an industry through this growth phase. We have grown production. We've done a tremendous job of making efficiencies and growing production, but we've not done a good job of efficiently managing cash flow. And that's now in the new age, post-COVID and even pre-COVID, we are in a phase of our industry that has to have free cash flow. I just don't know how to emphasize that enough. So our platform is based on that. And as we go forward, that's the type of assets we're going to look at. So I'm pleased to answer any questions that someone might have, or to talk more about Mach as we've laid out our strategy here.
Thank you so much, Tom. We really appreciate your remarks and all of your insight into industry, including stories from the earliest days of your career in Oklahoma. I certainly remember, too, coming up in South Louisiana, that due to the boom, that housing was very difficult to find, and those were quite the times back then. When talking about free cash flow, and that's just where industry is going to have to be going forward, not just go there, but be there going forward. Mach has been built. You described it as, in your slides, the last owner. Does that mean that your plans are to produce these assets to depletion versus plans to build and flip? What could you tell us more about last owner?
Sure. I do believe that we're in a time period that you need to be prepared to own these assets and own them through the depletion of the asset. So whenever we look at a prospect or a projection to buy proved developed producing reserves, we price that as such that we'll have to hedge that out. So if you have any kind of debt against it, you have to have a long-term hedge. So you have to buy your properties at a price that you can make a decent rate of return off of the production without any upside, and be able to throw off enough free cash flow to make a return for us and the investors. So we have always had a model of making distributions. So what we do is that we have cash on cash returns after debt service, after CapEx, and we make distributions to our investors. And so that is how come we've been successful. But the only way to do that is you have to buy at a price that you're only valuing the reserves that are producing.
Well, speaking of buying at a price where you're only valuing PDP, essentially, I think is what I heard. Considering the circumstances, the oil price environment right now, this year, are there a lot of properties you're seeing already on the market? Do you anticipate more properties coming onto the market? Are these properties you're interested in?
Yes, we think there'll be many more properties than there is capital to buy them. Basically, there has to be forced consolidation. So ultimately, what you're seeing is that in each deal that we've looked at, there have been billions of dollars wiped away. The equity is obviously gone. Second liens are basically gone. The companies are moving towards bankruptcy, and there has to be some type of consolidation or sell. And so right now we're seeing a lot of Chapter 11s. I think there's a lot more to come, or there's going to be mergers. and there has to be this, as I say, forced consolidation. So and the way we look at the world is that there is, especially in the Midcontinent, it's a very depressed time, that there will be less management teams. There will be those with capital will be able to thrive, and those who are be able to be efficient can do really well. So like with the Alta Mesa purchase that we made through bankruptcy, Alta Mesa had 155 employees, and we took on not only the E&P company, but also the midstream, and added 14 employees. We added very little G&A whenever we bought that property. We have 90 people that are basically a SWAT team of the best people I've ever worked with, and that are corporate employees that can operate thousands of wells. We have 2,500 operated wells. We have 55 well interest in 5,500 wells, and we do that with 90 corporate employees and $18 million of G&A. That is what you're going to have to do. And then when we take on the next 100 wells or the next 300 wells, we have to be able to do that and not increase our G&A hardly any. That is what the investors today are going to want they want to be investing into an efficient company that can operate thousands of wells and have free cash flow. Now I'm only speaking about more of the private companies, not large public companies. So I know there are very many very well capitalized large public companies. I think you've heard from Harold before me. Continental is a fine company that can always access capital. Devon, others in the Midcontinent are going to be just fine. I'm only talking about those of us who are in the more of the smaller range that have to be consolidated. But they're still, that represents billions and billions of dollars of capital.
And in that smaller range, you mentioned fewer management teams. In terms of G&A, which you referenced as well, being at least a private company versus a public company, the G&A associated with that and SEC reporting and compliance and such, I imagine it's obviously a great deal less. Do you feel like you want to continue your advantage in terms of producing returns by continuing as a private company, or do you have plans to potentially tap public equity markets at some point in the future?
I don't see a real benefit to being a public company today. Whenever we went public as both Sandridge and Chesapeake, there was an advantage to being a public company. You could access either high yield credit markets or equity that private companies couldn't really do. And so having access to capital is not the issue today because you have no more access to capital as a public company than you do a private, unless you're a large public company, over $5 billion of market cap.
Tom, do you feel this may persist? I suppose not in perpetuity. Nothing really lasts forever, they say. But persist through potentially a generation?
I wouldn't necessarily say that. I think that this looks a lot to me like 1998, where we are going to have a decline in production in the U.S. We've relied on the U.S. for growth in oil production, which has meant associated gas, which with also very low gas prices. At the same time, we have very low oil prices now. So this is, I think this changes very quickly, especially in natural gas as we have less oil rigs running. There is a limit to how much gas can come from the Northeast. So the reason we look at the Mid-Con is because it's a good area to be able to get gas to the hub. And that's, as we start using more LNG and we continue to rely on natural gas as the key supply to offset wind and solar and move to a more green energy, we will be seen as a green energy fuel. or will have to be, because you have to have it as a backup. It's impossible to do the new deal, the new energy deal, without having natural gas as part of the equation. I think that travel over time comes back and demand in oil comes back. Natural gas is something I just think there's a very bullish outcome out in the future. We don't rely on that. We don't see hope as a strategy, but we do believe that over time there'll be options for us and all of our investors if we are able to deploy capital in the next few months to years.
I'm sure you had it in your slides, but I overlooked, what is your current net gas weighting amongst your assets?
We have focused on oil just because that is where the best returns have come from, but we still we have close to 60% gas and liquids that are in our mix. So we do produce a lot of natural gas. And if you're going to produce in the Mid-Con, you are going to have a natural gas component.
And then also, and thank you for bringing up nat gas. I did want to talk to you about that. Also, to your outlook, I'm getting the impression, I've technically heard your answer through your presentation and through your Q&A here, but your outlook for recovery and oil demand, quarters, years, maybe that'll happen sooner than we think. However, the investor appetite for upstream stocks, it may be much, much longer before that recovers.
Well, I believe that. So I believe and did believe even before pre-COVID, price war, that we had too low of prices, that we were buying very distressed companies prior to March of this year. So $50 oil doesn't get us anywhere. We haven't even got started. So I believe that we have to have a much higher price in oil to move forward to get new capital to come into our business.
Tom, thank you so much. And there's a question everyone I interview, including yourself, over the years, I always like to ask. That's the what else question. What have I not thought to ask about that you would like to make sure fellow members of industry, prospective investors understand about Mach Resources?
Oh, I think you know all you need to know about Mach Resources. I do believe that good can come out of this, that new companies can start, that new investors can come in, and there is still, as there always will be, an oil and gas industry that we can rely on.
Wonderful. Thank you so much, Tom. Really appreciate it. And again, it's really, really great to see you after all of this time.
Thank you.
Thank you for your remarks this morning.